In October 1973, war broke out in the Middle East and Arab nations turned off the oil spigot. Prices quadrupled. The S&P 500 dropped 17% in a single quarter and then fell another 30% the following year. It was a painful reminder of what happens when oil gets weaponized. Nobody gets to sit in the sidelines. Fast forward today, and the echoes are hard to ignore, but a lot's changed. I'm Jim Dunlop, managing partner of Advent Partners, and there are three things driving the markets this week. First, the Fed held rates steady at 3.5 to 3.75% last week. There's no surprise there. What was surprising? Four members dissented, the most since 1992. They dissented to the messaging. And the translation is this, that even the people who set interest rates can't quite agree on what comes next. So if you're confused, you're in good company. Second, the conflict in Iran and the effective closure of the Strait of Hormuz have pushed oil above $100 a barrel. That strait normally carries 20% of the world's seaborne oil. When shipping costs spike, those costs don't stay at the gas pump. They find their way into groceries, airfare, and just about everything else. That's the inflation risk that we're watching closely. And third, and here's probably the good news, the S&P 500 closed at an all-time high above 7,200 recently. Why? Earnings. 84% of S&P 500 companies beat estimates this quarter, the best rate since 2021. With blended earnings growth north of 27%, corporate America is delivering and forward outlooks have actually improved. So the US economy remains resilient. In 1973, we learned that even resilient economies have their limits. So the reminder here is stay diversified, stay informed, and we'll keep you posted. Have a great week.